Hello, friends. Welcome to Kavita's classroom. And today's topic in hand is yet another interesting topic of how the elasticities determine the incidence of tax, means the burden of tax on buyers and sellers. So before proceeding ahead any further, let's just talk about what do we mean by tax? Why is it imposed? Who imposes it? Why means what benefit does it give to the society as a whole? So when it comes to tax, it's a mandatory levy. You cannot avoid it, right? So it's mandatory levy, and that is on the individuals and corporations, and it is levied by government entities. It can be the local government, regional government, or the national government. It is imposed because it's a great source of revenue for the government. So revenue generation is one prime important point for this. Then discouraging the consumption and production of goods with negative externality. Like there are certain things like alcohol, tobacco, liquor, all these things which have negative impact on the society, and with the market failure. When I say market failure, means the market forces of demand and supply determine some level of quantity to be produced in the economy, but that is not the desired quantity because it has got some negative impact. So the production and exchange of that thing should be reduced. So that's called the market failure. So to just balance out the market failure, government tries to impose tax for the reduction of consumption and production of such things with negative externality. And then tax also is a tool to control the inflationary and deflationary tendencies prevailing in the economy, leading to the recession and boom situations. And it's again an important tool for redistribution of income and hence reduction of inequality. So now let's understand first. This is the basic structure of demand and supply curve, which simply determines the equilibrium price and quantity of a commodity. So this is the basic structure, right? But when the taxes are imposed by the government, the supply is reduced. How much is the per unit tax? This vertical distance is the per unit tax imposed by the government. Now, because of this tax imposition, there is new E dash which is made, and this new equilibrium decides a new price which is higher and new quantity which is lower. Right. So this way it tries to curb on the production and consumption of negative externality products. Right. So when this comes, it means now the quantity traded after imposition of tax is OQ dash, which is lesser than OQ, the previous quantity, and people are now paying OP dash, which is higher than the price determined by the free forces of demand and supply. Now let's understand how much is the tax revenue here. So because this vertical distance is the same as this, right? And I'm marking this as K, right? So if this is per unit tax and the number of units which are now exchanged are OQ dash, it means this is equal to P double dash K. So what is the revenue? Revenue for the government or the total amount of tax collected is tax revenue, I'll say. This is equal to P double dash K E dash and P dash, right? But out of this whole revenue, how much is contributed by the sellers and by the buyers? So for this, you must understand whatever is the price over and above the previous price, which was determined by the free forces of demand and supply. So this much burden, which is above the previous determined price, that is borne by the consumers, and this below this is borne by the producers. So it's very much clearly indicated here in this diagram that this mesh is consumers, right? And when you talk about this spiral sort of thing, that is producers, right? So this is, but it is not always so. In this very particular diagram, you're able to see that they are tentatively contributing the same amount of tax, means maybe 50-50 in this diagram, but this is not always so. How much burden falls on consumers and how much burden falls on producers primarily depends upon the elasticities of demand and supply. So let's understand today with the following diagrams. See that how the elasticity of demand impacts the burden of tax or the incidence of tax on buyers and on sellers. As I told you, so in all these diagrams, I'm trying to highlight what is going to be the tax revenue. This vertical line and this horizontal line, this box would create the tax revenue, right? I'm just trying to give you the amount of tax and the quantity which is traded. So this box like structure would be the whole amount of tax, right? In all these five cases. And what are these five cases? In these five cases, I have tried to show the elasticity of demand to be less than 1. See, it is vertical orientation, right, of demand curve. Greater than 1 means it's more of horizontal orientation. It is flatter curve. E equal to 1 is just in the mid, unitary elasticity. Elasticity equal to 0 means perfectly inelastic demand curve, which is just vertically upright, right? And then elasticity perfectly elastic means it is having infinite elasticity, which is going parallel to x-axis. So now in all these diagrams, we see that because of the imposition of tax, the supply curve shifts from S to S dash, which is leftwards, right? So in all these diagrams, we see the same happening. And because of that, there is some tax revenue which is to be paid to the government. So if I try to show you whatever is the price over and above the previously determined price, that box would be contributed by the consumers, right? And the box which is below the originally determined price, right, would be contributed by the producers, right? So let us try to have this comparative analysis here. In this case, we see that as and when the elasticity is getting reduced, like in case of perfectly inelastic demand curve, the whole burden is borne by the consumers. This fourth case talks about the whole burden to be there on the consumers. And this is more when it is inelastic, right? So when it is perfectly inelastic, the whole is taken up by the consumer. When it is little inelastic, majorly inelastic, right? So it's the major contribution is given by the consumers. On the contrary, when the elasticity is perfectly elastic, the whole of the burden, because there is no price rise here, so the whole tax revenue would be paid by the producers. In the last diagram, here it is. And again, when elasticity is high, means E is greater than 1, here the major contribution is given by the producers. And when it is E equal to 1, then it is both contributing the similar amount. Okay, so what is the crux of the story? What have we learned out of this? As the elasticity of demand rises, means the producers are not very sure of the demand, so they are bearing major taxes. But when the elasticity is falling, means when the producers are bit sure of the demand from the consumers end, they shift that burden to the consumers or buyers. I hope the concept is clear to you. Thanks for watching. Bye bye. See ya.